Welcome back to Learn SKN, and today we have another economics video for you, another CSEC economics video. So we're going to pick up where we left off last time. We were looking at money and the supply and demand of money, and so today we're going to be looking at the role of the central bank. So we're going to dedicate this video to just the role of the central bank. And so from your syllabus you can see that the role of the central bank includes monetary policies, supervising other financial institutions, and then under monetary policy you see that they have certain tools that they can be used to basically control monetary policy. Now, what is monetary policy? Monetary policy is the manipulation of the money supply to achieve certain broad economic objectives, right? So monetary policy can be defined as the manipulation of the money supply to achieve certain broad economic objectives. Now, the objective can be whether to reduce inflation or whether to increase employment, reduce unemployment, that kind of thing. So the monetary policy is used normally in marries with the fiscal policy to control the economy. But for monetary policy, you can define it as the manipulation of the money supply to achieve certain broad economic objectives. You can say macroeconomic objective if you so desire. And so the central bank has certain instruments or tools at their disposal to assist with the monetary policy. But before we jump into those, we are going to just give you a general gist of the role of the central bank, and then these instruments would come out as we look at what the roles entail. And so we're going to jump in the economics textbook, the one most of you all would have, and we're going to go through them and see what we can break down and what we can explain. The central bank is the head of the financial sector in an economy. The central bank is not involved in ordinary banking business. Its twofold purpose is to oversee the operations of all financial institutions in the economy and to implement monetary policy on behalf of the government. So right there you see one of the jobs, the roles of the central bank. They are the ones, they are a creature of the government, and as such they carry out the monetary policy for the government. So they are the ones who deal with the government account. They are the government's bank, or the government's banker. They are the ones who help with the debt repayments. They are the ones who aid with the borrowing and all those things as it relates to the government. They are the ones who keep the economy at a certain level using monetary policy. And of course, they are the banker's bank, so they're in charge of all the financial institutions in the economy. Those are the two main jobs of the central bank. And of course, they use different tools to achieve these objectives. Also, the central bank, another job of the central bank is to basically inform persons. You know, they carry out certain surveys and things like that, and they keep statistics so that they carry out research, they sponsor research papers and stuff like that. So that's another minor role of the central bank. And so if we dip back into one of the POB slides, I did a video for POB with the central bank, function of the central bank before. And so if you dip back down into that slide, you can see a whole lot of other functions of the central bank. So it controls the currency, manages public debt, promotes financial stability, manages monetary policy, as we said before. But the thing is, you see, POB would separate this. They say influence interest rates. But in managing the monetary policy, the interest rate is also a tool used to affect the money supply. They issue treasury bills, they manage foreign exchange and hold reserves. And they are the banker's bank. They hold commercial bank reserve requirements, regulate commercial banks, operate payment systems, lender of last resort. If a commercial bank is on its last leg, the central bank would be the lender of last resort. Also, research, data collection and analysis, financial and economic education. So all those are some of the roles of the central bank. And of course, we're going to delve deeper into some of them from the econ perspective. And so we're going back to the textbook, and we're going to delve into some of them from the econ perspective. Now, before we continue, the central bank. Now, some countries, or not all countries, have the same central bank. For example, the OECS, their central bank is ECCB, or the Eastern Caribbean Central Bank. For Barbados, it would be the Bank of Barbados. For Guyana, the Bank of Guyana. For Trinidad, the Central Bank of Trinidad and Tobago. The Bank of Jamaica, for Jamaica, of course. You have England, have the Bank of England, and America, of course, would have what they call the Federal Reserve or the Fed. So different economies, different countries have different versions of the central bank, but most of them play similar or the same role. They print the currency, they send out the money, stuff like that. All the roles I listed just now. So just let's remember that, right? So we are in the Caribbean, and in the Caribbean alone, there are many different central banks. Like I said before, small islands in the Eastern Caribbean, that's the ECCB, is their bank. Jamaica Central have their own bank. Guyana have their own bank. Trinidad and Guyana and back. So, but the thing is, one of the strongest central banks in the Caribbean happened to be this one right here, right? The Eastern Caribbean Central Bank. That is one of the strongest banks in the Caribbean. Anywhere in the world, actually. It's a very, very strong bank. The exchange rate for one EC dollar is about 2.71. You take 2.71 EC dollars to get 1 US, right? In other countries, in Jamaica, it's way more than that. Trinidad, it's way more. It's like 1 to 6 or 1 to 7, something like that. So yeah, but the Eastern Caribbean Central Bank is one of the strongest banks in the region, in the world altogether. Somebody once told me that the EU kind of imitated the European Currency Union. They imitated what we have here in the Caribbean, in the Eastern Caribbean Central Bank. Okay, good. So let's go. Functions of the bank. The central bank performs the following functions. It has the sole right to issue notes and coins for the country. That's just self-explanatory. So the central bank is the only entity that can issue coins and currency in any country. The Fed, they issue the coins and currency in America. Eastern Caribbean Central Bank, they issue the ones for the OECS, and the list goes on. So it has the sole right to issue notes and coins for the country. The central bank is the sole issuer of new notes and coins in an economy. It also accepts and replaces unfit notes and coins. So that's a very simple function right there. We don't have to go too deep into that one. It is the bank of all commercial banks. All commercial banks must keep a percentage of their deposit as cash reserves at the central bank. The central bank lends to the commercial banks if this is necessary. Commercial banks also seek to accept advice from the central bank. They have to report regularly to the central bank on various aspects of their operations. So the central bank controls basically the financial sector within any economy. The central bank is the one who controls the commercial banks and even the other financial institutions that are not banks, such as credit unions and cooperatives and those kind of things. So the central bank is the bank of all commercial banks, and they implement the rules and the regulations and laws and stuff like that. They also, of course, each bank, they have to deposit a certain amount of money into the central bank, and that will come into play later on when you're looking at some tools to control the money supply, because this reserve is a key part in helping to control. It's a part of monetary policy, and it helps to control the money supply in one way or the other based on what they want to achieve, whether to increase the supply or reduce it. They can use the reserves as a tool to achieve whatever goal they are trying to achieve. Next one. It is the banker of the government. As I said before, it's the government's bank. The central bank keeps the accounts of the government. Just as corporations and individuals hold deposit accounts at commercial banks, the government holds deposit accounts at the central bank. These accounts are used to receive funds, making payments, and clearing checks issued by the government departments. The central bank lends to the government if the government needs money. It manages the national debt of the government. The national debt is the sum of all outstanding government borrowing internally within the country and externally. So one thing you have to note here is that in some countries, their version of the central bank is not owned by the government. Some of them are private entities. For example, in the USA, the Federal Reserve is actually a private entity. It is not a government entity. In the Caribbean, majority of the central banks are government entities, because, for example, in the Eastern Caribbean, the ECCB, the financial ministers for all of the countries that are part of the currency union, they are basically the ones who have a say as to how the bank operates and stuff like that. So yeah, so it's more a government entity than, for example, the Fed. So that's the next one, the bank of the government. They handle all of the government's business as relates to borrowing and repaying the debt. All right, it implements monetary policy on behalf of the government. And we said monetary policy is the manipulation of the money supply to achieve certain broad economic objectives. When there's inflation and the economy is overheating, inflation means that there's a general rise in all the price levels in a place, in a country, in an economy. Things just going up, everything is getting more and more expensive. That's inflation right there. When things just keep going up, getting more and more expensive. We don't want that. Because as I said, the economy will begin to overheat. And that would cause people to lose jobs, production go down, demand go down, a spiraling effect that is negative on an economy. So, the central bank will implement deflationary monetary policy. For example, it might increase interest rates. So, I'm going to read out this, but we're going to go more in depth with it when we're looking at them individually, right? So, for now, we're going to say it implements monetary policy on behalf of the government. So, let's continue. Next function is it manages foreign exchange reserves. The central bank looks after the foreign exchange reserve account. It ensures that the country always has sufficient reserves, and if it does not, advise the government on the appropriate policy. It also protects the exchange rate from fluctuations. Finally, the central bank is the government's representative in all international financial matters. So yes, so the central bank tends to control exactly how much foreign currency reserve is held in by a country, because we all know that the US is the dollar of business. Even in China have a lot of US dollars. So the US is the business, the currency of business on the international market for the most part. And so you just can't have people just buying US every day and then deplete the reserves. So the central bank would monitor how much of the reserves are there. Now, a side note, like when I went to Jamaica to study, I was very surprised to see that you can go to the ATM and actually withdraw US from random ATMs. That was very shocking to me. Gone to the ATM, you can actually withdraw US dollars. Like the bank not controlling the reserves like that at all. But in other countries, smaller countries, the Leeward Islands, the OECS, the bank actually stipulates how much should remain. You can't go to a bank and just randomly withdraw a large amount of US. It's not gonna happen, right? You have to put up over time. But so that's just a central bank controlling the reserve of foreign currency. And so you'll realize that some countries would have what you call a fixed exchange rate, like the OECS countries, and some would have a floating exchange rate, which means the law of supply and demand determines the strength or weakness of that currency. So like Jamaica and places like that would have a controlled or floating exchange rate. So it moves. So, but some countries like in the Eastern Caribbean, the currency union, they have a fixed rate, and so they don't really have to, that's why they have to control that so tightly, because you don't want anybody getting too much in the hand, depleting the reserves, and then, causing problems when time comes to spend money overseas. All right, so the next one, non-bank financial institutions, as I said before, like the credit unions, etc. It supervises non-bank financial institutions. In most countries, the central bank supervises the operations of other financial institutions, such as insurance companies, pension funds, investment trusts, for example. This is the case in Trinidad and Tobago, right? So that's the central bank. So the video is getting a little longer than I would like. So I think I'm going to stay here. So we're going to stay here for now. So we looked at the functions and the roles of the central bank. We're going to stay here for now. And when we come back, the next video, we are going to look at monetary policy and the instruments used to carry out monetary policy, right? For the next video. So stay tuned for that one. That's it for now. Thanks for watching. Thanks for listening. And stay tuned.